Let's briefly discuss the cash flow statement. The cash flow statement is prepared on a different basis of preparation to the income statement. Remember, we discussed how the income statement is prepared on the accrual basis of accounting. This involves the accountant using the accrual concept to accelerate and defer revenue and expense items through the income statement to construct a representation of the performance of the firm. The cash flow statement is prepared on a much simpler basis. It's prepared on the cash basis. This involves identifying the cash inflows and outflows that have occurred during a specified financial period. Those cash flows are then analyzed into three mutually exclusive categories: cash flows that relate to operating activities, investing activities, and financing activities. The cash flow statement can provide us with important information about the fundamentals and the dynamics of a firm. Let's discuss the first section of the cash flow statement, cash flows from operating activities. This section of the cash flow statement bears a strong relationship with the firm's working capital and the income statement, and therefore indirectly retained earnings. Many of the transactions and events that are recognized in the income statement are also recognized in the cash flow statement, only they're recognized on a cash basis. The cash flows from operating activities section tells you how much cash the firm has generated during a financial period as a result of its operating performance. If the company prepares this section of the cash flow statement using the indirect method, this section will also provide an interesting laundry list of accrual adjustments that the accountant has recognized when preparing the income statement. In other words, this section will provide a list of accelerated and deferred revenue and expense items in the income statement that have no cash basis. The cash flows from financing activities section of the cash flow statement bears a strong relationship with the parts of the balance sheet that reflect the two sources of finance that the company avails of. In other words, the equity section of the balance sheet and the non-current liability section of the balance sheet. The cash flows from financing activities section of the cash flow statement describes the cash inflows and outflows that have resulted from the company transacting with its capital providers. In other words, its equity and its debt holders. The cash flows from investing activities section of the cash flow statement bears a strong relationship with the part of the balance sheet that reflects the long-term productive capacity of the firm, or the non-current asset section of the balance sheet. Cash flows from investing activities section of the cash flow statement outlines the additional cash that has been invested in non-current assets or the productive capacity of the firm, and also cash inflows as the firm divests or reduces its productive capacity by selling off non-current assets. Later in the series of presentations, we will discuss the finance concept of free cash flow. We will use an income statement-led approach to calculate free cash flow. Bear in mind, there are alternative ways to calculate free cash flow. We could use the cash flow statement to calculate free cash flow directly. We could do this by taking the cash flows from operating activities and subtracting off the additional investments made by the company during a financial period necessary for its growth, or its CapEx. We can arrive at a figure for the CapEx of a firm for a financial year by scrutinizing the cash flows from investing activities section of the cash flow statement. We could scrutinize the list of investing activities that has occurred during that financial period, and we could pick out the ones that we believe represent the additional investment or CapEx during the year necessary for the firm's growth. So we could calculate free cash flow by taking cash flow from operating activities and subtracting off select cash flows from an investing activities section of the cash flow statement. A free cash flow model involves forecasting financial statements and using those forecast financial statements to calculate measures of free cash flow. To do this competently, you must be comfortable with the characteristics of the different financial statements. This slide provides a list of useful definitions that we will rely on later when we build our free cash flow model. Read through the list of definitions and make sure you're comfortable with each one. In addition, make sure you're aware of where you might find the information required for each one of these definitions in the different areas of the financial statements. Next, we will discuss the mechanics and the underlying logic of a discounted cash flow model.